Here is something nobody really tells you when you first start thinking about investing. It's not the stock market that stops you, it's not the risk, and it's not even the money. It's the feeling that you aren't quite ready yet. And you tell yourself that once you've got a bit more money saved, or once things have settled down, or once you actually understand it properly, then you will start investing. But what happens is the months just go on and on and on. And if that sounds familiar, this video is for you, because in 2026, the barriers to starting have never been lower and the cost of waiting has never been higher. So here are 7 things worth understanding if you're starting to invest right now, or if you've been meaning to start and just haven't yet. Over a year, there was money sitting in my current account, not because there wasn't a plan and not because there wasn't intention, but because the platform that felt right to invest in had a minimum deposit of £1,000 to open. So the waiting started, and the idea was to save up to that number and then begin properly. The whole time it felt sensible and responsible, but it wasn't. It was just waiting dressed up as preparation. And you might be doing the exact same right now, just with a different number in your head. It's a bit like, you know, that friend who says they'll join the gym once they've lost a bit of weight first. And that's not how it works. You don't get fit and then join the gym. You join the gym and that's how you get fit. And investing is exactly the same. You learn by doing. The longer you wait to start, the longer you delay the most important financial education you will ever get. And before we get into it, nothing in this video is financial advice, and your capital is always at risk when you invest. So let's move on. Before a single penny goes near an investment account, there are 2 things worth having in place. The first is clearing any high interest debt. If you've got credit card debt sitting at 20 or 30% interest, that is where your focus belongs right now. No investment reliably returns more than the interest rate you're paying on consumer debt, so pay it down first. The second is building an emergency fund. The Money and Pension Service recommends having at least 3 to 6 months of outgoings saved in cash before you consider investing. Not because investing is dangerous, but because life is unpredictable. If your boiler goes, you lose your job, or something unexpected comes up, you don't want to be in a panic selling your investments to cover it. Think of it this way, investing without an emergency fund is a bit like building a house on sand. Things might be fine for a while, but the first time the ground moves, shifts, everything becomes unstable. The foundations are not exciting, but they are the reason everything else holds. So once you have those 2 boxes ticked, you're in a position to invest. There is one rule that completely changes how scary the stock market feels. Most people have never heard of it, and once you know it, you can't unknow it. And it's only investing money you will not need for at least 5 years, and that's it. The stock market goes up and down in the short term, and that is not a flaw in the system. That is just the way the financial system works. But historically, over every 5-year period on record, the market has usually trended upwards. And the danger is not market volatility. The danger is investing money you might need in 18 months and watching the market dip, panicking and pulling out at a loss. That's how beginners lose money. Not because investing is risky, but because they've invested they couldn't afford to lose. So before you put anything in, ask yourself one honest question. Could you realistically need this money within the next 5 years? If the answer is yes, it belongs in a cash account. If the answer is no, you're in the right territory to start thinking about investing it. That one question will remove most of the fear. This one is genuinely underused, and it costs people a lot of money every single year without them realizing it. If you're employed in the UK, your employer is legally required to contribute to your workplace pension under the auto enrollment. The minimum is 3% of your qualifying earnings on top of the 5% you put in yourself, and that is 8% going in before the government adds tax relief. But here is what most people do not check. Many employers will match contributions above that minimum. Some will match up to 5, 6 or 10% if you put in the same amount. So every pound your employer adds is a pound that has not come out of your take-home pay in the same way because of how the pension tax relief works. Pension does lock away your money until at least age 57 from 2028, and that's worth knowing because some people prefer to also invest separately in a stocks and shares ISA alongside their pension because that money stays accessible, and both can make sense depending on your situation. But the first move is simple. Speak to whoever handles payroll at your workplace and ask the one question: what is the maximum contribution the company will match, and what do you need to contribute in order to get it? Not doing that is the equivalent of leaving part of your salary uncollected every single month. There is a number on most investment accounts that quietly costs people tens of thousands of pounds over a lifetime, and most people never look at it. It's called the annual management charge or the ongoing charges figure. It's expressed as a small percentage of everything you have invested, and it gets taken whether your investments go up or if they go down. The reason it matters so much is compounding, not just compounding returns, but compounding costs. And here is what that looks like in real numbers. Say you invest £100,000. One fund charges 0.1% a year, another charges 1.1%. That 1% difference looks tiny, but over 30 years at identical returns, the cheaper fund leaves you with roughly £114,000 more. The expensive fund has to significantly outperform the market just to break even on its own fees. And according to data from the FCA and independent research from Pocketwise, over a 10-year period, approximately 85% of actively managed funds, the ones with fund managers picking stocks and charging higher fees, fail to beat a simple low-cost index fund anyway. So when you are comparing where to put your money, look for the total expense ratio, which is basically just the all-in annual cost of holding the fund. And for a passively managed index fund, you should be looking at somewhere around below 0.25%. For most actively managed funds, you'll see charges close to 0.75% or above, and that difference compounds against you silently for decades. Fees are the one part of investing you can actually control. Everything else has some uncertainty where the costs aren't, so make sure you take a look at them and pick something that is low cost. Over 85% of professional fund managers, people who do this for a living with teams of analysts and decades of experience, fail to beat a simple index fund over a 10-year period. That is not an opinion, that is what the data consistently shows, including research from the FCA and the fund performance data published by the S&P. So before you start picking stocks, it's worth asking, what exactly are you trying to beat? An index fund does not try to pick winners, it just buys the whole market. A global index fund might hold shares in 9,000 companies across the world in a single purchase. When one company fails, the others carry it. When the market grows, you grow with it. And Jack Bogle, the man who invented the index fund, put it quite simply: don't look for the needle in the haystack, just buy the whole haystack. Within the FTSE All-Share, between 2014 and 2023, only 39% of individual companies beat the index return over that period, according to research from FISI Money. Think about what that means if you had picked stocks at random from that index. You had a better than even chance of underperforming the thing you could have just bought as one fund. Single stocks can work. Some people do very well with them, but they take time, research, and emotional discipline most people underestimate. For most people, starting out at a low-cost global index fund is the most evidence-backed starting point there is, not because it's exciting, but because it works. Every single person who has ever panicked and pulled their investment money out during the market crash has regretted it. Every single one. The market recovered from 2008. It recovered from the COVID crash in 2020. It has recovered from every significant drop in modern financial history. The S&P 500 has delivered an average annual return of about 10% since 1957. Not every year, some years were brutal, but across the full period, 10%. The problem is that a market crash feels like a crisis in the moment. It feels like the right time to act, to protect yourself, to get out before it gets worse. But the people who acted on that feeling and sold usually ended up crystallizing their losses and then missing the recovery. This is what people mean when they say time in the market beats timing the market. Nobody consistently calls the top, nobody consistently calls the bottom. The people who try to do both usually end up selling low and buying high, which is the exact opposite of the plan. The simplest strategy, putting money in regularly, not checking it obsessively and leaving it alone, has consistently outperformed almost every attempt to be clever about it. Zoom out, look at what the market has done over 20 or 30 years, then remember that the short-term noise, the headlines, the scary graphs, that's all it is, noise. Patience is a strategy in investing. It might be the best one. Remember that past performance isn't an indicator of future performance. It doesn't guarantee that it is going to be the future performance, but it is a good indicator. The most expensive financial mistake you can make is not a bad investment. It is waiting. According to the Investment Association, the average person in the UK believes they need around £41,300 before they can start investing. The reality is that most platforms let you begin with £1, and only 22% of people know that they can start with less than £50. So that gap between what people think they need and what is actually required is costing millions of people years of compounding returns that they will never get back. You know that friend who says they'll join the gym once they've lost a bit of weight first? That's not how it works. You don't get fit and then join the gym. You join the gym and that's how you get fit. And investing works exactly the same way. You learn by doing. The market will teach you things no book or video ever will. How you actually feel when your portfolio drops 10%, how tempting it is to sell, how discipline is built through real decisions with real money on the line. Every year you delay is a year of that education you don't get back. So start small, start imperfect, because the one thing every single person who has ever built real wealth through investing has in common is that they wish they had all started earlier. Just a disclaimer, nothing I say is financial advice. Your capital is always at risk when investing, but if you found this useful, there is a newsletter link in the description which you can sign up to. Each newsletter is one idea, one framework, something worth knowing about your money. That's it, but it's linked below. Or if you liked this video, YouTube recommends you watch this next.